I'm Managing Editor Kim Schmidt. Welcome to On the Record. Here's a look at what's currently impacting the ag equipment industry. Deere & Company released its first quarter earnings for fiscal year 2016 this morning. The company reported net sales for its first quarter of 2016 fell by 13%. Worldwide net sales were $5.5 billion compared with $6.4 billion last year. Net sales of the worldwide equipment operations declined 15% for the quarter. In the U.S. and Canada, sales decreased 18%, and sales for the rest of the world were down 11%. Company equipment sales are projected to decrease about 10% for fiscal 2016 and to be down about 8% for the second quarter compared with the same period a year ago. Included in the forecast is a negative foreign currency translation effect of about 3% for the full year and second quarter. For fiscal 2016, Deere's net income is forecast to be about $1.3 billion. A recent report from Avondale Partners suggests that this year may mark the cyclical trough for Deere. Igor Mariasis, senior research analyst at Avondale, said in a note that by their calculations, NAFTA large ag equipment industry sales expectations currently factored in to Deere's 2016 guidance already seem to imply levels that are close to the troughs reached in the last three down cycles. Because of underproduction in 2015 and 2016, Mariasis says Deere can more or less maintain its 2017 large ag NAFTA production levels unchanged from the prior year, even if retail demand declines by as much as double digits. On the other hand, if the industry's 2017 retail sales stabilize around 2016 levels, Deere's production would have to increase by double digits just to catch up to retail demand, he says. The firm's current consensus assumes Deere's ag and turf sales grow by about 1% in 2017. This would imply a potentially high single-digit decline in retail sales for NAFTA large ag next year, on top of the 25 to 30% drop Deere's projecting for 2016. Mariasis says historically, equipment sales have been closely correlated with net cash farm income. For 2016, USDA is now projecting net cash farm income to drop by 2.5% after declining 27% in 2015. Given the historical correlation, it appears that net cash farm income would need to deteriorate further beyond the projected 2016 levels for the industry retail sales to decline by more than what is already baked into the current consensus for Deere in 2016 and 2017. Linda Salem, president of Great Plains, expressed similar sentiments regarding the tillage and planter manufacturer during the AEM executive panel during the National Farm Machinery Show last week. Salem says their dealers are retailing equipment at a faster pace than they are reordering it, but you can only do that so long before you have nothing to sell. Based on the supply on hand at dealerships, she says they are about to hit equilibrium on the pre-boom days or the old normal. Salem says 2016 will likely be a normalizing year for Great Plains, and if commodity prices and business stays the same in 2017, they ought to see an uptick in sales. This week's dealer on the move is Custonia Tractor. John Deere dealership Custonia finalized its acquisition of A&M Farm Center's 2 locations in Crown Point and Valparaiso, Indiana. This brings Custonia's total stores to 5. Now here's technology editor Jack Zemlicka with the latest from the Technology Corner.
Thanks, Kim. With increasing emphasis on the agronomic value of precision farming technology, partnerships between farm equipment manufacturers and data-driven service providers continue to emerge. Earlier this month, John Deere announced its collaboration with California-based Agrion to deliver the company's Prescription Creator platform. Starting this spring, the software will allow farmers to import, track, and manage seeding and fertilizer prescriptions through Deere's online Operations Center portal. While the addition of agronomic expertise is a relatively new concept for many farm equipment dealers, it's an area that Deere is continuing to develop. Many of the manufacturer's dealers are partnering with other ag retailers, crop consultants, and agronomy experts to assist customers with creating maps, analyzing field data, and writing prescriptions. At last week's National Farm Machinery Show in Louisville, we caught up with Deere product manager Laura Donaldson, who shared the company's plan to assist dealers in developing collaborative services for machinery and agronomic data management.
Most of our dealerships in the future, we're asking them to have a certified crop advisor on staff. And the reason for that isn't because we want to enter that agronomy business, that agronomic space, but we want to make sure that our equipment is agronomically advanced. So we want to make sure that there's someone at every dealership that's able to be a part of those conversations and that can help with those conversations with their customers.
While Donaldson notes that Deere's primary focus will remain on machinery, she adds that dealers are being trained and prepared for the addition of precision ag technology in the future. She expects that equipment sales will be driven by guidance, telematics, and wireless data transfer technology available on the new machinery. Back to you, Kim.
Thanks, Jack. Last week at the National Farm Machinery Show in Louisville, Kentucky, we had the chance to sit down with Steve Nicholson of Rabo AgriFinance. One question we're regularly asked is if we've heard any good news out there. Nicholson offered some insights on any bright spots there might be.
Probably the best news is that we've probably thrown all the bearish factors of the market we can, whether it's corn, soybeans, or wheat. There's probably not a lot of bearish factors yet to come. So I would tell you that the bottom line, the bottom line is that we've probably pretty much hit the lows, and we put those lows in. But the other side of that coin is, okay, so what's the bullish news? And there probably isn't a lot of bullish news out there at this point. We continue to raise, it looks like we'll probably raise a good crop this year. Now it's early, we're here in February, and it's hard to decide with that, but the fact is we're probably going to continue to build stocks over the next year or more. And so it's probably limiting the upside to the commodity prices. And the other side that's a little difficult to try to get a handle on is that prices look like they're going to be pretty flat for an extended period of time, and that's going to create not a lot of opportunities for the upside or downside, whether you're a seller or buyer of grains going forward. So it's going to be a very difficult time, and we have some pretty stiff economic headwinds in front of us as far as agriculture goes.
The Federal Reserve Bank of Kansas City released the results of its fourth quarter survey of agricultural credit conditions last week. In the fourth quarter, 87% of survey respondents said farm income was lower than a year ago. In fact, it was the first time since 2002 that bankers in all states covered by the district reported farm income for the fourth quarter was lower than the year before. According to the report, persistently low prices for ag commodities remained the primary driver of reduced farm incomes. A sustained weakness in corn, soybean, and wheat prices has had a particularly negative effect on farm income in the region because these three crops account for 70% of harvested crop acreage in the 10th District states, according to USDA. What's happening in the 10th District appears to be consistent with the national average. In USDA's most recent Farm Sector Income and Finance report, it's projecting net farm income for U.S. farmers to decline for the third year in a row. USDA forecasts net cash farm and net farm income for 2016 to be $81.1 billion and $48.9 billion, respectively, in inflation-adjusted dollars. These amounts are both below the 10-year average. While production costs are forecast to contract in 2016, it won't be by enough to offset the commodity price declines that are expected as well. And now from the Implement and Tractor Archives. The concept for the Farmall F12 one-row corn picker came in 1921 from engineer Bert Benjamin, who suggested the design of a Fordson-like tractor with more ground clearance and a narrow front end for cultivation and plowing. He could not get either Ford or Harvester to build the design at the time. More than 10 years later, the F12 was built almost exactly to his specifications in 1934. As always, we welcome your feedback. You can send questions or comments to kschmidt@lestermedia.com. Thanks for watching. I'll see you next time.